What's up, y'all? Bottoms up, everyone.
Hey, good
Doc,
evening. How are you?
what's going on, Ian?
Same old, same old.
Well, that's boring.
Well, I got nothing. I'm sorry.
I'm teasing. It's like when I go, well, I don't know about now. I go get my physicals, and my doctor is like, "This is boring," and I'm like, "Good."
It's
I
supposed to be
like boring.
boring.
I like boring when it comes to healthcare.
Been there, done that. It's supposed to be boring.
Supposed to be boring. So, what's going on, everyone? Stocks on the rocks. It is Thursday night. Here we are, happy hour. We have a little cocktail. Let me know what you're drinking over there if you're drinking anything, and we'll get the show on the road. But nice to see you guys here. This is something we do every couple of weeks where we do an open office hours, hot chocolate kind of night. I like it. Hot chocolate, man. I can't imagine doing hot chocolate today. I think it's like mid to high 80s out here right now. And I'm like, nah, man, I can't do anything hot. Um, but we do these stocks on the rocks, open office hours, happy hour every other Thursday. Invite your friends, invite your family, invite your enemies, whoever you want to invite. The more the merrier, right? These are always fun because we get to just do open Q&A, very relaxed. Um, I don't come planned with anything to talk about. We have 8 trading rooms a week, not including the futures mastermind that Ian and Carl are doing each week. And so we have a lot of live trading rooms and sessions that we come prepared with stuff to talk about. So this is a session for you guys to come with stuff to talk about, ask questions, bring us your challenges, bring us your wins, any questions. And if I don't know the answer, I'll go find it, or I'll try to find someone who knows the answer. Um, but oh, nice. What's up, Liz? Pinot Grigio kind of night. Excellent. I love it. Now we're talking. 85 in Florida. Mike, where are you in Florida? I don't know if I've asked you that question before, but I spent 20 years. I played all my music, grew up in Florida, spent a lot of time playing volleyball at Daytona Beach. A lot of time. So yeah, I lived in Orlando, so it was a quick hour drive over to Daytona. And so yeah, I used to spend a lot of time out there. 1 block from the beach. I love it. I spent a lot of time in Daytona and Cocoa Beach, a little bit in New Smyrna, and a little bit in Clearwater. But yeah, anytime my buddies and I were going to go do something at the beach, it was always nice. It was always weird to me, but I always liked it that you could drive on the beach. So Daytona was always good for that. Pull your car up and find a volleyball court and just say, I got next game. And we had a lot of fun doing that. It's been a long time. But yeah, so this is kind of a makeup session. So I say we do it every 2 weeks. I don't know Steve's diner. I don't remember anything. We're talking last time I was in Daytona Beach, I was probably goodness gracious. I mean, I've been in California for 20 years, and before that, I think it probably been 5 or 6 years since I've been to Daytona, unless it was for a concert or something. But man, yeah, it's been a little while since I've been out that way. So I don't know. I don't even know if I knew how to get there without navigation. But it probably somewhat looks the same, but probably somewhat looks different. Um, but when I say that this is a makeup session, I had a schedule conflict last Thursday and had to postpone last Thursday, so we put it on this Thursday. So be prepared. We're not switching the schedule. So next Thursday we're doing another happy hour so we can stay on the same rotation of every 2 weeks. So we're doing 2 weeks back to back. So we came to visit Florida. Maria said we're not going back to California. I kind of wish I could do the same, but I've got too many, as they say, irons in the fire. My kids play music. This is where they need to be. They're still teenagers. All of our, friends, a lot of my wife's family is out here, some of which need help, um, physical help and things like that, aging, that kind of stuff. So I could bring some wood branch next time I come. I'll probably, I don't know, I might try to get there maybe spring break or something, next year for a little bit. Not spring break specifically, but somewhere around that time, April. One of the companies that I built a mentoring program for is having an event out there, and I might jump out there for a little while. if they pay me to be there and pay my way. We'll see. But I would probably not move to Orlando this time. I'd probably move back to like South Florida. We have some really close friends in Palm Beach, Del Rey area. So I like that area. So I'd probably consider more like that area this time around if I did. So cool. Nice to see you. All right. So, like I said, this session is purely designed off of whatever questions and challenges and successes you guys want to talk about. Whatever you want to talk about, let's talk about it. So the chat box is open. I've got the ability to give you want to turn your camera on, you're more than welcome to. It's up to you. You want to turn your microphone on, up to you. Just be family friendly, if you will. We had some problems opening up in the past to the public cameras and microphones. Just be adult about it, if you don't mind. That would be awesome, because that got a little weird a couple times ago. There you are. What's up, Mike? What's up, Liz? I see you back there. All right. So regarding what's that, Mike? I can hear you.
Hey, buddy, how you doing? It's good to see
Good,
you
how are you?
again. Long
Good
it's
to
been a
see
day
you.
or two.
It has been a minute, that is for sure. So, Carl asked the question, kicking it off, regarding the one-to-one credit spreads such as Walmart and FND. What are some of the general characteristics of the underlying that allow this kind of trade? Great question. So let me get rid of that and that. And I'll bring a platform up. So let's start with Walmart. Oh, good, Jason. I was hoping you did, because I found nobody that knows anything about VWAP. So I'm glad you did. So let's talk about that here in a second. So Walmart, when I had built the Walmart trade, this was back when Walmart had dropped into this pocket of daily, weekly demand. And I thought, man, it looks like this thing is poised to bounce off. And I really liked how these candles were forming down here, showing a little bit of green every day. We got a nice confirmation candle here. And I have to go back and see exactly what day we got in to tell you what I was seeing in the chart. And so we got in on the 28th. And you'll notice that I'm in a put spread here where I sold the 97 put. So keep that in mind. And I bought the 96 put as insurance, right? So I just got a dollar wide spread. So the most, you can't see my screen. Is that just for you? Nike Sports Camps, or can you guys see it all right? Can you guys see it? You can see it. All right. So
Looks
check this
good.
out. Look, yeah. So Nike Sports Camps. Do me a favor here. So at the top of your main Zoom window, you should see a couple tabs. One of them should be Corey's screen. We'll cut a tab at the top. Do you see that? Of your main Zoom window.
I'm looking at it right now. Let's see. I don't see anything that says Corey's. Okay, let's see. Yeah. Yeah, but you're showing double. That's all. Like I see you on the small screen, the big one. So it's probably just my deal. I'll fix it. No problem. I'm sorry.
Well, let me try this. Sometimes the best medicine is to just start over. How about that?
Let's see. No, it's my end. I don't want to mess up the whole class, so I'll figure this out. It's no
Yeah,
problem.
if you poke around, you have like a like if you in your Zoom dashboard, your little toolbar, you
Yeah.
should have a button that says show meeting. And if you click that button, maybe that Corey's screen will come up.
Yeah. Okay. I'll keep working on this then. All
Okay.
right. Thank you.
Cool, man. Yeah, so on this Walmart trade, keep in mind that this was a September 12th trade. So we got in August 28th. So it was only, what, a 2.5 week trade. Sold the 97s. That's important. Bought the 96s for insurance. So I have a dollar wide spread, and I got it. So the most this spread could be worth on the risk side is a dollar worth of risk.
Oh.
But I opened it for a 50-cent credit. So now the most I could lose is 50 cents. The most I can make is 50 cents. So keeping that in mind, the 28th is here, right? So it's this second green candle, and price had started to move away. And Walmart's got pretty low implied volatility overall. And I mean, this thing is practically in the teens. It's so low. But it was at about the low 21% rate on implied volatility, which You know, implied volatility being that low is generally not going to offer really great premiums when you're selling options out of the money. And at the time I was looking, I prefer to sell spreads below the whole demand area here. So I was looking to maybe sell some 94s just to kind of get the short strike below here, maybe some 93s if I could, but there was no premium selling out of the money options on such a low vol stock. And so since I thought the market was going to rally sharply, I could have done a bull call spread, which in hindsight might have been better, probably would have been better. But I didn't really get a great risk reward for a bull call spread. I think it was like 1.5 to 1 to see if price could get back up to the origin of the gap down. But it had to make a significant move in order to get 1.5 to 1. So what I did is I built at this time when the stock was at 96.06, I sold an in the money put. That's the important part. It's in the money. So now you're not just getting extrinsic value, which is all the implied volatility and time value stuff. I'm getting $1 worth of intrinsic value, which brings in $1 worth of premium right off the bat. And then by buying the 96s, I had to pay pretty much at the money premiums, you know, for selling an in the money option for the offset. And so I was getting about the same 1 to 1, maybe a little less. It's 1 to 1 for the bull put spread, but I was getting a little more for the bull call spread, but needed a much larger move. And I was happy taking a 1 to 1 for the next 2.5 weeks. I said, if the stock just trades and closes above 97, I'll make the 50 and I'm risking the 50. I don't even need a stop on it. So I was looking for a good risk reward on the option trade where I didn't need much movement. Ideally, I don't need any movement, and that's where I sell out of the money spreads most of the time. But on a case where I think the stock is still going to trickle higher, I can sell an in the money option, but I still need if I'm not going to have a stop on it, which I prefer not to if I don't have to, I need that 1 to 1 at least reward to risk. And this one ended up shooting straight up to the origin of that gap. So again, I probably would have got 1.5 to 1, you know, on the bull call spread, but I needed a 6% move in the stock for that. For a 1 to 1, I needed a 1% move in the stock, just trade above and close above that orange line. And so I was able to close out that trade early, specifically close it out on the 4th, didn't expire until the 12th. So on the day that it was actually getting right up into this area, I was able to close that out for a nickel. So I kept 45 cents of the 50, still practically 1 to 1. And the thing I liked about it is I didn't need that big move. I was happy to get it, but I didn't need that big of a move in order to get that 1 to 1. So on the is it FNT? No, what was the other one? I just entered it today. I already forgot the symbol.
FND.
FND, that's right. FND. I saw something similar, which was basically, you know, and in all fairness, you know, we talked about this in the trading room. This is an uptrend. We do have some supply up here that I am, you know, a little bit concerned about that it's not going to break above that. So the profit margin on price breaking out above this area for a directional bull call spread wasn't even 1 to 1. And I needed stock to move up to 95, 96 to even make that 1 to 1. And the stock was trading right around 98.18 this morning. And then with an out of the money bull put spread, I'm like, well, if I even go out of the money by 1 strike and go down to the 87.50 or I think it was 85 is the only strike available. Might have been 80. Yeah, there was an 87.50. But if I go down here and I start selling below current price options, now my risk reward is way out of whack. And now I'm risking a maximum of 2 to make 1. And I'm like, how do I build this as a 1 to 1 where I don't need much movement, but I still need some? And that's where I chose to do this 90 short put, 87.50 long put. So I have a $2.50 wide cent spread here. I got $1.25 in credit. So I got today. I get that FND. $1.25. So on a $2.50 wide spread, the risk is $1.25. The reward is $1.25. Right now, it's closed above where I need it to. Now, in all fairness, I need it to stay above 90. And if it rallies, hopefully we can close it out a little bit early. But I'm looking for basically where do I think the stock is going to be? And I say, if I think it's going to be above, here's my range. If I think it's going to be above that yellow box, even if it wasn't at the time of entry, if I think it's going to stay above that yellow box, then that's when I start looking at potentially selling an in the money put spread, which has a little bit of a directional bias, but not a real strong directional bias. Does that make sense, Carl? Some mild directional bias.
So is it
Corey,
something that you can do with all, I mean, a majority of option trades, credit spreads,
Yeah.
doing it this way?
Yeah, technically, absolutely. Right? Because if you had a directional outlook that the stock was going to actually go up, you could choose between a bull call spread, which is a debit spread, and a bull put spread, which is a credit spread. And I think what you'll find interesting is if I take this spread, which is now worth $1.10, and I build the exact same bull call spread using the same strikes. Now it's aftermarket, so these spreads are a little bit wider, but technically, if you add together these two premiums, right, when the market's open and the spreads are nice and narrow again and things are open, these two premiums, what you receive on a credit spread and what you pay on a debit spread should be the exact amount. If you total them up, should be the width of the $2.50 spread.
Mhm.
And that's to prevent from any arbitrage opportunity. Like if you could get more, like imagine you could get $1.35 for the credit spread and $1.10 for the debit spread. And you were to, for instance, sell the call spread or sell the put spread and sell the call spread. You would have almost a risk-free trade here if you had an arbitrage opportunity between the put spread and the call spread using the same strike, same expiration. So what they do is they basically keep those two premiums while the market's open in line so that you can't pay less for one and receive more for the other. So this would be taking a at the money bull call spread versus an at the money bull put spread. It's the same trade. One you just pay a debit for, one you receive a credit for. But if you had a directional bias on a stock that was pretty strong and you wanted to sell an in the money put spread, not an out of the money put spread, you could get a better risk reward and treat it as that. Now, I generally only do in the money put spreads personally when I have a mild bullish outlook, like I do on this one, and I can't get any premium or a good location for an out of the money spread. Walmart, I did have a little bit more of an aggressive outlook, but the bull call spread was only paying, like I said, about 1.5 to 1 reward to risk, and it needed to move 6% to get it. The bull put in the money had a 1-to-1, which is a little worse risk reward, but it only needed to move 1% to get it. So I favored that one more than the bull call.
Okay, got it.
That makes sense. Any follow-up questions to things like that, Carl, while we're on the subject?
Sorry?
Any follow-up questions while we're on this subject?
Not at the moment.
Okay.
Thank you.
Corey, I've got one.
Liz, what's up?
So, do you have any criteria on how far in the money you're willing to sell your short strike? Because, I mean, I'm just trying to get my head around this concept that would you not potentially be at risk of assignment on your short strike?
Sure. That's a great question. Anything that's in the money and you're on the obligation side of that, you're at risk of assignment. Now, if it's barely in the money, the risk is almost nothing, right?
Right, which is why I asked my question. I mean,
if it's
you don't want to be ridiculously in the money.
if you're ridiculously in the money, you've got assignment risk, but here's how I would gauge ridiculously in the money too. And here's the only time I've really found myself getting assigned early on any option. And you can point to extrinsic value for that, right? So let's take FND. I almost forgot the symbol again. If I look at extrinsic value, got to keep in mind that if I sell these in the money puts at 90. Well, they were in the money. Now they're out of the money. The extrinsic value is over $4 for those options in October. I would find that it would be 0% chance, as close as you get to 0% chance, that somebody who owns the 90 puts is going to exercise those puts and throw away $4.35 in premium, which is the extrinsic value, right? Now,
Right.
I come up here to these, 130 puts, and now we're getting almost no extrinsic value. So if the extrinsic value is diminished by so much because they're so far in the money, the probability of assignment does become greater.
Right.
Right. So I would feel fine if we thought the stock was going to make it to 95 and trade at 95 and stay above 95. I'd technically be okay selling the 95s because they still have over $2 of extrinsic value.
Okay.
Right. But now
Yeah.
let's also discuss what happens if you get assigned. Is that terrible? Well, the worst case scenario here is you lose 50 cents on this spread, for instance, right? You can make 50 cents, you lose 50 cents. So if you get
Right.
assigned early on the 90s, what does that mean? That means I have to buy stock, right? So now I own stock at 90, but I still own
The call.
the 87.50 put,
Right.
right? So what's my risk? It's still 50 cents.
Yeah. Okay.
You know what I mean? So the risk profile doesn't change. I still have protection below 87.50. As a matter of fact, I would argue that if you get assigned early on a short option, you've achieved your maximum profit potential before expiration. So I would actually encourage being assigned early if I could. Because
Yeah.
remember,
Okay.
right? Because the whole credit spread thing is you can make the maximum if everything expires worthless, or if you're assigned, on the and I'm sorry, and if you're assigned on the short strike early, you get to keep 100% of that premium you collected up front. Otherwise, you have to wait all the way to expiration to get 100% of the premium, right?
Right. Okay. That makes sense.
The cool part is if you do get assigned early, and now you've realized all the income premium on the 1 year short, if those 87.50s are still worth anything, you could turn around and sell the stock for where it's at, and then sell the put options that you bought. In this case, I forget what we bought them for, but let's say you bought them for, $3. If they're still worth $1, you can sell those for $1 and make more than the 50 cents.
Yeah. That makes
Because
sense.
you've
Okay.
made
Yeah.
all your money on the short leg, but you still have value in the long, so dump the whole position and make your money early. So you can't force early assignment, but if you got early assignment on any short option where you're a part of a spread that goes for bull call spread, bear put spread, bull put or bear call, you get assigned early on those short legs, you've hit the maximum profit potential earlier than expiration. It's the best case scenario. Unfortunately, it doesn't happen often.
Yeah. No, that makes sense. I just kind of got to think that one through because I've never been used to doing them in the money, but
Sure. Yeah. Yeah, no, it's a good way. I mean, I generally only use the in the money, credit spread when I need like a mild move, and the bull call spread, for instance, doesn't pay a lot. And in this case, the mild move paid 1-to-1 and an aggressive move paid 1.5-to-1. I'm like, I'll take the mild move for 1-to-1, you know.
Mhm.
And if it makes an aggressive move like Walmart did, then it just means you get to exit early.
Even
And
better.
even better. And even an aggressive move like this. I mean, the stock moved 6%. Now, granted, I got out on the 4th, so it probably moved about 4%, but I still wasn't assigned on the 97s. It just closed for a nickel because I had the order waiting to buy back for 5 cents. This is awesome. I love the conversation. That's great. Yeah, it's a lottery win, Mike. That's right. If you get assigned on a short leg early as a part of a spread, you hit your maximum profit potential early. And what was your defined maximum profit potential is now better, especially when you still have premium left on the long leg that you can turn around and sell. It's best case scenario. I wish it happened more often where I got assigned on short legs on a spread, but it doesn't.
So would you ever consider just closing out the long put and then just holding the stock and let it ride?
If you
Because
got
you could
assigned
then,
early,
yeah, yes, if you got assigned early, because then, I mean, potentially you could make an absolute fortune if it's going to rip.
if it looks like it's going to rip and there's nothing standing in the way, I would certainly consider that for sure. And you have a pretty good sense, I'm speaking to you personally, Liz. You have a pretty good sense of stocks that have this tendency to run. So I would
Mhm.
see that there would be an opportunity for that. Just
Okay.
take,
Yeah, I mean,
you own the shares, and if you don't need the put anymore, then just sell the put or let it go. Just let it expire.
right. Maybe in that case, be fairly aggressive with your stop on the stock.
Right. Because then
Because
it
otherwise,
shifts from a whole different risk profile. Yeah,
otherwise you could end up causing yourself like way more harm than good. But
oh,
yeah, okay.
definitely.
All right.
Yeah. Yeah, there's no way I would take a situation like Walmart, take delivery of the stock, and then let the protective put go and, still keep a stop way down here under demand. No, you're
Yeah,
you're you're
that would
aggressively, you have a stop as you normally would
right.
uh, under the
Just
last, known demand or last known pivot or something like that. Or
right.
take some money and buy a new put option, and now you just have, long stock with a protective put.
Right. Okay. All right. No, that makes sense.
Yeah, awesome. Great question. What's up, Maria? She asks, I see how an in-the-money bull put gives you more credit. If we were to combine that with weekly expiration, since they decay faster, would that be too aggressive? Or is there a way to structure in-the-money weekly responsibly? Yeah, this one wasn't a weekly option. I sold a monthly option. That was the expiration series, but it was only 2 weeks away. So same thing applies. Let's take, for instance, the FND. Let's go back to that. It's not the exact same position as it was this morning when we entered, and we can't because there's no weekly options. Okay. Well, I guess this is a weekly option, right? So if you were looking at, now 90 by 87.50, because it's already, the 90s are out of the money already, you're not getting a 1-to-1. But when we got in, it was somewhere around 89, maybe 89.10. So you would have gotten another, whoop, you got one too many decimals in there. You probably would have gotten in the neighborhood of $1.10, yeah, probably $1.10 for those, maybe $1.11. That's pretty darn close to 1-to-1. You know what I mean? Just get above and stay above 90 by next Friday, and that's still pretty close to a 1-to-1, right? And that's actually, I didn't even consider that this morning. Probably should have, in hindsight, because my problem now, thanks for bringing this up, Maria, is I need this. That's actually good. Is I need to see this stock get above 90, number one, now that they're all out of the money. And I need it to stay above 90 if I want to get close or rip a lot higher in order to get close to buying that spread back for, a large portion of the profit potential to close it early. If this is a 1 week option, you've got a very steep delta curve here, which means you don't need very much movement, not only to get above 90, it doesn't need to stay above 90 for more than 8 days. Where were you this morning, Maria, when I was building this trade out? Because when you ask questions like that, it causes me to think about, what did I do? What could I have done differently? It's probably something I could have done differently, is explore the September version, because I didn't think I needed that long. I just happened to be looking at October options and went for those. So in hindsight, would have been probably almost equal to 1-to-1, not quite, but 10 cents for 8 days versus, 10 cents more risk for 8 days, or 10 cents less risk for 36 days. And hindsight, probably would have rather done the Septembers. But also, Like you could say, well, what about can you do another one, Corey, and go 92.50 by 90? Yeah, and I would definitely get better than 1-to-1 for those. But now where do I need the stock to be in the next 8 days? I need it to be above 92.50. So there's a balance between how much do you need the stock to move, and is a weekly time frame enough time to see the stock above your short 92.50 strike. So that's the balance too, Maria. Right? Is if you only give it a week and it doesn't make the move, now you got to manage that, each week. So there's a trade-off for that. So I would always look at how far does this stock need to move for my in the money put to become out of the money. And if I choose a weekly or a 2-week option, is that enough time to make that move? And if it's not, you got to go out a little bit further until you think it's going to be able to make the move of that magnitude within that window. Does that make sense, Maria? Yep. And then one management thing that you need to be aware of is that if if the short put is not out of the money, so like let's say the stock closes in between the two strikes, or is about to close expiration day, and it's about to close in between the two strikes. What do you do if the stock is in between 90 and 87.50 and it's expiration day? What happens if those 90s are in the money, but the 87.50s are out of the money and you hold through expiration? You know what happens there? If you have a microphone, it might be easier to just say it versus type it, but I'm curious if you know the risks of holding something where the market price at closing is in between two spread strikes. By the way, if anybody else wants to chime in on that question, that's a question for Maria, but it's a question for everybody. I want to make sure everybody understands this.
Gamma risk.
What's that?
Gamma risk.
Well, at expiration, there should be almost no gamma. You're talking going into the very end of the day, the close. There should be almost no gamma, but there is some gamma risk if prices are fluctuating big. But I'm specifically talking about the risk if it's 10 minutes before the market is about to close and the stock price looks like it's going to close in between your short strike and your long strike.
Bail in a hurry before the close.
Right. But why? Here's your short put. Here's your long put. If the price is in between, why would you hurry up and bail before the close?
Well, you will be assigned.
You'll be assigned on the obligation leg, which means now you're going to own shares at 90, but your protective leg is going to be worthless.
Expired
So on
worthless.
Monday, you're just going to be long a bunch of stock at 90.
Yeah, you're
And
assigned.
now your risk is no longer 50 cents. Your risk is the stock.
Good dog.
Going to zero.
Technically, yes.
So you need to be out before close.
You need to be out before the close if it looks like the stock is going to close below your short option. But not below your long option. I'm talking specifically in between the two. So if the stock is above your short option, everything is in the money. I'm sorry, out of the money.
Out of the money.
And everything expires worthless. You keep the 50 cents. If everything is in the money, because the stock is below your long leg, then you will be assigned on both legs, which means you're going to buy the shares at 90. You're going to sell the shares at 87.50. All that's automatic. You'll keep your 50 cent, the $1.25 credit, and you'll lose the $1.25 on selling the shares. So there's no problem holding the position through expiration if the stock is above 90, your short put, or below 87.50. The problem is in between. That's where you run into you're assigned on one, but the other one expires worthless. So now you lose your protection. And Carl asked a great question. What about after hours trading? After hours trading is tricky, right? Because once the option market closes, there's nothing you can do, right? So if the stock is hovering around your short put going into the close, what would you think is going to be the best course of action if it's hovering around the short put, right around the short put going into the close? What do you think the best course of action to be to not get stung by after hours trading.
Get out of the trade.
Get out of the trade. Just close it for whatever
Yeah,
it's
close
worth.
it off. Why take the
Close it for
chance?
whatever
'Cause,
it's worth.
yeah, you can always go back.
Yeah. I mean, if it's out of the money when you close it, you'll end up making some money, maybe not the full 50 cents, but you'll end up making something,
Mhm.
right? But at that point, it's all about risk mitigation over the weekend and having to take delivery of a stock after hours, over the weekend, and then you have no protection on Monday.
Yeah, that's too
So,
much risk.
yeah, yep. So go to Vegas and double down. You're probably better off. You're probably better off. But,
Good
it only
question,
takes
though.
one time for you to get assigned on the shares. Your put protection goes away and the stock gaps up, and you're like, look, I knew I should have hung on. Look at all the money I just made. And then you start making that your habit, and then that happens sometimes, and you're like, man, it's
Mark
like going to
Douglas-
Vegas.
Mark
Somebody
Douglas
goes to
kicks
Vegas.
in, anything can happen.
Yeah, anything can happen. It's like the guys that go to Vegas, and I say, like, my buddy John went to Vegas, and he's like, yeah, I came home with 10 grand. He's like, I won 10 grand. And I was like, yeah, you've been going to Vegas all year. Are you up for the year? He's like, oh no. Oh no. No. I'm still down 40 grand for the year, but I got 10 back, I'm like, yeah, okay. However you want to justify it, buddy. Great questions. I love this conversation though, right? This is the stuff that sometimes we learn the hard way, but hopefully we don't have to. And that's why we have these sessions. So we don't hopefully have to learn the hard way. It's awesome though.
So then it sounds like if we do this type of strategy, ideally the shorter to expiration, the better. Which, I mean,
Ideally.
obviously would be the case for an in the money, for an out of the money bull put spread or credit spread of any kind anyway.
Yeah. Yeah, any kind of spread, any spread, even a debit spread, where you expect that the short strike is going to be in the money at expiration, every type of spread, vertical spread, would be better off shorter term.
Mm-hmm.
But like I said, there's that balance between how big of a move do I need? And do I think I'm giving it enough time by choosing a weekly option to be, to have that short strike, taken out by price? Whether it's a bull call spread and you need the stock to be above 95, or it's a bull put spread and you need the stock to be above 90. There's the balance between, yeah, short term is great because you get the benefit of theta, but leaving enough time for the stock to make the move that you need it to.
Right. Well, I mean, I guess
out.
with Floor and FND, Floor and Decor, then there only are monthly options anyway, so you don't really have the choice.
Right.
Some of the much more liquid stocks, obviously, you do have weekly options with very good liquidity, but there are other stocks where you do have weekly options, but the spreads on the weeklies just absolutely stink. So it makes no sense to be doing a credit spread on a weekly option that's got a very wide spread.
Agreed.
So it's kind of a balance. I mean, so maybe there's really only a certain universe of stocks that this kind of strategy actually makes sense to do.
Yeah, I think so. And I'm going to always try. If I think the stock's going to make a pretty aggressive move, I'm going to always try and build the bull call spread because you'll make more money generally relative to your risk.
Right.
But let's look at this XPEV for a second, because that's one that we're kind of waiting on a little bit too, XPEV. Where it's just like we were waiting to see if the stock can get above 21. It starts to work its way out of this demand here. We were waiting a little bit to see if the stock could get above 21. And this was looking at a 19 by 18 bull put spread, which is out of the money. But, if you were thinking, I think the stock is going to actually make a move, but the risk reward's not great, I might consider something like 21 by 20. Nope, not 1950. 21 by 20. And that pays 54 cents. That's 1 to 1. and you're actually a little bit better than 1-to-1, but let's call it 1-to-1, and the stock only needs to be above 21. So it doesn't require an aggressive move. It just requires the stock to move another 42 cents to the upside. And can it do that in 8 days? Probably. It's not that far away. I probably wouldn't choose a 23 by 22, because now the stock has to be above 23. But if I just need it to be above 21, that's not unreasonable. 2050, it's already out of the money. 2050 by 1950. See how much that drops off, though. That dropped off to now. The risk is twice the reward potential. But that 2050 is already out of the money. So yeah, I like weekly options when you don't need a big move. It's great. If you need a big move, you need to give it time to move.
Agree.
Yeah, it's starting to move, so we'll see. All right. What else you guys got? The no stop thing is great regarding gaps. I do love that. Which is why for my directional spreads, I don't love to have stops on them, because I want to be able to give it time to actually do what I think it's going to do without having to worry about getting stopped out just before the move. How frustrating is that? You can't really pull off the no stop thing on selling out of the money put spreads or call spreads. Can't really do that because the risk reward is way too out of balance. But if you want the no stop thing and you want to use credit spreads where you don't need a huge move, but you still need a little move at the money or slightly in the money, it's the way to go. Slightly in the money should do it. You don't need to be that deep in the money.
Well, I think the no stop thing also helps with position sizing, because, for example, if you're doing a debit spread, let's say you're doing a bull call, and you're sort of trying to set yourself a deadline for when you need to be stopped out by, if you're going to be stopped out, then you've got to somewhat arbitrarily sort of figure out a date and say, okay, I'm position sizing so that if I'm wrong, I need to be wrong by a month from now, 2 months from now, whatever the number is.
Right.
And that can be a bit arbitrary. So like you say, you can get stopped out only to see the thing move like the very next day.
Mm-hmm. Been there, done that. Yeah, what I like about the no stop thing too is to your point, to expand upon it, it eliminates the need to even care about volatility or time decay. Right? Because time decay could hurt a position the longer you're in it, depending upon if it's in a bull call spread. That's why you need to have that time-based, exit. So you're just minimizing the effects and the need to even care about some of the mechanics in the options. And that's what I like about spreads anyway, is it reduces exposure to theta and vega and delta. So that's less mechanics you have to worry about. But then if you can take it and say, well, let me build a trade where I don't need a stop, then I don't even care how long it takes to get to stop or target. It's the same, it's the same regardless, risk reward. So it does take some of the need to worry about the mechanics of options out of it. And Liz, you remember meeting Rob Reinhold at the Summit here in Anaheim.
Yes, I do.
And he told a story that he was bad about placing stops and adhering to them. And he knew it and he admitted it. He's like, I was bad about it. He's like, I'd see these stops and I'd see the stock coming down and I'd pull my stop and I wouldn't adhere to it. And so knowing that, he just built into a strategy that says, I'm not even going to bother with stops. I'm just going to build a strategy to where the risk reward is worth it with no stop.
Right.
Which you can't really do in stocks. You can't really do that in futures, but it's totally doable in options, which is why he's primarily an options and Forex trader, but primarily options.
Okay,
Yeah,
Corey,
that
I
makes
got to
sense.
ask you a question here.
What's up, Mike?
I'm trying to wrap my head around the fact that what you're saying is building a trade with no stop. I'm just that terminology has got hairs on the back of my neck going. I don't understand it yet. You're saying build a trade with no stop. Right.
Which means you're willing to risk what? How much of your investment are you willing to risk if you have no stop?
Well, what I would, if I'm buying it, it's what I'm paying for it.
Right. Well, it's 100% of the risk profile of the trade. Credit spread, it's whatever the risk is in the credit spread. So in this case of for instance, XPEV, if we did this 21 by 20, it's a dollar wide spread, right?
Okay.
The worst that spread could be worth for you is $1. So you could lose $1 if you lose everything on this trade. But because you bring in 54 cents, now your worst case scenario is the other 46 cents, worst case scenario. So it's a 1-to-1 reward to risk with no stop to see if the stock will trade and close above 21 or trade and close below 20. So I don't need a stop because I'm comfortable with the max risk and max reward in the position. So I don't even need a stop. So the
Got
risk
it.
reward has to be worth it to risk everything in the position for me to have no stop. So like there's another trade over here that we're in. It's called Soundhound that I built. When do we enter this one? We entered this one on 10/17. So where was that? Sorry, 8/25. 8/25. So I entered it here. Wasn't even at the zone yet. I just got this sense that, you know how you just have this gut feeling and you can't support it technically. I even think I said that in the room. Like I have a gut feeling, but I can't support it technically. Technically, I should be waiting for 11/25, but it looks like it's stabilizing around that area. So I'm going to take a chance. And I'm going to enter a bull call spread with a target of just under 16. And I entered this spread, which is the 14 by 16 bull call spread. So I'm long the 14s, which were out of the money, and I'm short the 16. So I have an out of the money spread. So what does that mean? That means if the stock doesn't rise above 14, then I'm at risk of losing the 35 cents that I paid for this option spread. Does that make sense? 35 cents. I'm at risk. If it doesn't move and it falls away from here, I'm at risk of losing the 35 cents. But what if it makes it to my target? Well, if it makes it to my target at 15.87, I've got 3 contracts. So let's cut that 197, divide that by 3, 197 divided by 3. And the position is already up 65 cents in profit. So I'm risking 35 cents. Right now I'm up 65 cents. So I've got about 2-to-1 reward relative to risk, right? Which is my minimum. I'm willing to take 2-to-1 reward to risk on directional trades. Because of my track record, the amount of like my win percentage on directional trades, I'm okay with 2-to-1. So as long as I'm okay making 2-to-1, if the target is hit, risking 35 to make 65 or even 70 cents, then I'm not even going to bother putting a stop on it because the risk reward without a stop is worth it. Now, if I had paid 65 cents for that and I only stand to make 65 cents, that's a 1-to-1 on a directional trade. I'm not willing to take that trade. So you would need a stop to minimize your risk. But if you don't need a stop because the flat max risk, like look at this risk reward profile on this. Worst case scenario, I lose $105 at expiration. Best case scenario, I make 500 almost at expiration. So that's totally worth it. Risking 100 to make almost 500. It's almost 5-to-1. But I'm also concerned about what if it hits target early. So if it hits target today, or now let's go to tomorrow, I only stand to make about $200. But the longer it takes to get there, notice how that reward profile, the red line is pushing up. That means I'm making more money the longer it takes to get above that target. So at a very minimum, I make 2-to-1 if it hits in one day. If it hits later, closer to expiration, the risk reward relationship gets better. That's what I mean by I'm okay having no stop on a position like that, because I'm totally willing to take the worst case scenario to take the reward potential that comes with hitting my target today, and especially if it hits it closer to expiration. It's the only way I'd put I'd have a no stop trade on, is if the risk reward was worth it to risk the maximum to make whatever I was going to make at target. Does that feel better, Mike?
It's a little bit, I'm still understanding where you're placing the trades at. Because you're going directional on this, correct?
Yes. So I basically saw it here.
Okay.
I had a feeling it was going to go here. So I didn't buy an at the money option and sell the 16s at my target. I bought an out of the money spread. So for this to pay me anything at all at expiration, the stock needs to be at least above 14. And ideally, it's above 16. But if this stock does nothing,
You lose what you got. You lose your
35 cents.
position.
Yeah, 35 cents.
Okay,
But the
does that
reward
make sense?
potential to 60.
Okay.
But the reward potential, if it did hit target, was worth risking the full 35 cents.
Got it. You're buying it above you're selling it above where it's currently at.
Yeah, I'm trading
In fact,
something
in
that's
fact,
out
it's
of the
gonna-
money, expecting that move.
Got it. So you're going above and beyond. It's not there expecting it to go. It has to go above what you sold at for you to make money.
Yep, it has to make the move.
Yeah. Okay.
Yeah. So I would,
I
so
gotta
I
practice
take
that.
those. Yeah. So I take those types of directional trades where I'm aggressively bullish or bearish, in this case, bullish. And I think the stock's going to make a move of that magnitude. And I want to get as low a risk as possible to let this trade cook as long as possible to see if I can hit near that max profit return, which would be about 500 bucks in this trade, to risk about $100 on the 3 contracts. And to me, that's worth it. I'm not even going to bother with the stock. And now I don't have to worry about it. Now I don't even care if it goes down because I was willing to risk the 100 bucks because I position sized to risk the $100, and that's within my risk tolerance. So who cares if I lose it all? I mean, I care. I don't like losing money, but I mean, relative to risk reward, I don't care if I lose on this one because it's the same 100 bucks I would risk in any other trade
Got it.
in this account.
Okay. I got to play with that one.
If I'm ever long stock, I would never go without a stop. If I'm ever long an option position where the risk is greater than the reward potential, I would never go without a stop. But if the reward potential is suitable or better than suitable for the strategy at play, so like for me, a credit spread 1-to-1 is suitable. For a debit spread where I need the stock to move aggressively, 2-to-1 is suitable. So if I can get that and I can modify the strike prices and expiration dates to fit my exact outlook with the ideal risk reward where I don't need a stop. To Carl's point, I feel like I'm much more relaxed and I'm not waking up going, oh my gosh, is my stock in a gap past my stop? Because if it did, you'd lose more if you had a stop in place. Right? So I take a position size that where I'm willing to lose the entire amount, and then I sleep better at night.
I like that.
So it's just massaging and structuring the strike prices a little bit to like manufacture that risk reward relationship. Do you know what I mean? And that is the beauty, yet I don't want to say complicated, but there's a lot of moving parts and options, and it is, I'm glad they're called options, and pun intended, we have a lot of options.
Yes. Yeah.
No,
this beats credit spreads. There's a lot to learn, but it's just understanding the mechanics of it.
Yeah. Yep. And the only thing that's going to get you there is screen time. I love these sessions. I love the trading rooms because we can think outside the box and build stuff and try different stuff. And if it doesn't work, we'll abandon it. If it does work, it's like, oh, well, that's a little bit different. Let's actually explore what that looks like. I like the way that looks. That makes sense. It's like I'm teaching my 16-year-old who just turned 16 in May, and I'm teaching him how to drive. There's only so many things you can teach a 16-year-old on driving while they're a passenger. There's only so much you can teach them. You can teach
Hey,
them.
remember, you're talking to an insurance agent here, a retired agent. Okay.
Yeah, there you go. There's only so
Cares.
much you can teach them, right? There's only so much you can teach them. And so, you take an on-demand class, you take a live class, you read some books, you watch look at some slides and watch some YouTube videos. It's like, oh yeah, that's cool. I get it. right? Like I tell my kid, what do you do at a red light? Stop. What do you do at a stop sign? Stop. What do you do at a green light? Go. What do you do at a yellow light? He doesn't know. And I say, you stomp on it. What else are you supposed
Yeah,
to do?
you go faster.
Stomp on it. And I'm like, and then don't forget to watch out for that guy on the e-bike. Don't forget to watch out for that lady crossing the crosswalk with her baby. Don't forget to watch out for other drivers who generally probably have no idea what they're doing. And so you can't teach them that stuff out of a book. You got to get behind the wheel and actually drive. You got to do it.
Have an umbrella, buddy. Have an umbrella.
Have an umbrella. Oh, I got one. I got one. Question is a $2 million umbrella enough?
It depends on your, I'll tell you as the agent, it depends on your assets. Talk to your accountant and you
Oh,
insure
yeah.
to what you're worth, put your net worth times it by 10.
Okay.
Okay.
Yeah.
Because in California, they can attach whatever you got and put a weighting on it. It's a 10-year option,
Oof.
a 10-year lien with a 10-year option. It's worse than child support. So
Ugh.
it's a 20-year lien they could put, just so you know, hence why I left California.
I was going to say,
Florida,
all you're doing is trying to convince me to leave California even more, Mike.
what do you
If
think
I
I
don't have
left?
enough, if I don't have enough reasons to leave California,
Oh,
I just need
litigation
more.
alone. You know the little cafe down there in Lakeview and Lakeview, it used to be there, Lakeview and Bastion Cherry?
What's the cafe's name?
I can't remember. It's Lakeview Cafe forever.
Lakeview Cafe. I was going to say it's either Kimmy's, which I think is up the street from from that one you're talking about.
Yeah. The owner, my son, 16, driving on right there on Bastion Cherry,
Yep.
just tapped the back end of a Corvette. Just tapped it. No damage, no anything. First thing he did was grab an attorney. First thing he did was look at me and where do I live? And I was up on, up at the top of the hill there, Kerrigan Ranch.
Oh, nice. Yeah.
Yeah, and that was back in the day. And the first thing, his call when we subpoenaed his records, first call he made was his attorney, not even a doctor.
Yeah.
So have the umbrella because that's your first
Yep.
one that gets sued, and you want them in front of you. But
Yep. Yeah. My son barely tapped the back end of a Tesla. They were stopped
yeah. Oh,
at a red
Teslas
light.
are the worst.
At a red light, and he's in a Tahoe. He's in a Chevy Tahoe, and a
Ooh.
Tesla in front of him, and distracted by something, whatever. The turn lane starts to go, and he just thinks, "Oh, it's time to go, go!" And from
Go.
dead stop, 5 feet away, he ran into he just bumped the back of the Tesla, and yeah, and the driver got $7,000, the passenger got $7,000, the kid got 2,500. We had to pay for, I don't know, $18,000 in damages, and I mean it was all covered by insurance.
Oh, wow.
Yeah.
But I was like, what did you get $7,000 for?
Oh, yeah,
how did you
no.
guys get 16,000
Oh,
out of
soft tissue,
State Farm?
soft tissue damage in California starts at 10 to 15,000. Soft
Yeah.
tissue can't be disputed. I
Yeah,
hired
they
a
were
private,
like,
I hired a private investigator. We caught the guy climbing ladders, and my insurance company who I worked for said, we don't care. We just look at the mitigation, what the cost is, we're gonna settle.
yeah,
And
it's
the guy
ridiculous.
made out like a bandit, but put your house in a trust, LLC,
Yeah.
everything, insure yourself, get an
They
umbrella,
are.
let
They
the
are.
insurance, just try to
I
get
do
a
have
million
all
dollars
that.
from an insurance company. Good luck.
I do have all that. So it seems like I'm
Good
doing
man.
all right, hopefully, until I get out of California, then it'll be even
Yeah.
better.
Yeah. No, go to Florida. Can't touch you.
I know.
Sue me.
I love it. I love it. See, we learned so many different things and more than just trading. So, how much do we owe you for the consult, Mike?
Oh, that's it. Your classes are going to be wonderful. My wife is just, she is thriving on this. She has taken this like a mad woman. That's Maria.
I love it. I love it, Maria. That's awesome. All right, what else we got here? It's already, my gosh, how quickly an hour can go. It's already the top of the hour. Got any closing statements? Any closing questions? Any burning
You got anything?
desires?
I have the
Yeah.
stuff.
More
from
classes. We're going
Scott.
through your videos, man. They are
One.
great. Thank you.
Good, good. Jason, did I hear you saying
Fine.
something?
Yeah, I have the stuff from Scott.
Oh yes, tell me about that. What you
Okay,
got?
so he won't be able to come to this because he's traveling and teaching for the next few weeks.
Okay.
But whenever he's not traveling, he has Zoom meetings with us.
Okay.
And so for us, and usually the Zoom meetings are about what's currently happening for us.
Okay.
He did a little lesson on VWAP, and for the first time ever recorded it.
Awesome.
And so I'm going to post the link to that.
Okay.
And he also reminded me that he made a YouTube video either 1 or 2 years ago. I'll post that link in a minute here, and I'll also send them directly to you because I don't know who asked the question, but you'll be able to relay it to whomever.
Great. I love it. Thank you so much
So
for that. Appreciate that. So the links are
let me
going in the chat
get
box.
those into the chat before you end.
Sounds good. And then if you put them in the chat now, you won't need to send them to me. I'll just copy and paste them and put them over here in my little notes here.
Oh, okay. Yeah, because I'm not able to cut and paste stuff out of Zoom chats, but I'm not the host, and you are, so.
Well, I can't technically cut and paste either, but what I'll do is I'll open the link and then take the link from the
Okay, cool.
from the URL.
All right. I'll do that.
And that was from Scott Marzolano, right?
Marjolio.
Yeah.
It's hard to spell.
I always murder his name, like Marzolano.
Yeah, it's nothing like it's spelled.
Right. All right. So waiting for those, and then we'll land the plane as soon as we get those links. So don't forget, we will be doing this again next Thursday. All right. So here's the Zoom link. It looks like a Twitter link or an X link. That's one. Awesome, Sonia. Thank you. Yeah, I enjoyed tonight too, man. You guys have great questions. I love the
Okay. So
nice. All right, perfect. All right,
Okay,
thank
so
you.
that first one is the Zoom recording link to the meeting, and there's a password to it, but that's all there.
Oh, I see it. Yeah, okay, perfect. Yeah,
Yeah,
passcode.
and that, like I said, that's the first time he ever recorded one of our meetings.
Okay.
He did that so that I'd be able to share the stuff.
I love that. Thank you.
You're welcome.
Thank you. Thank you. No, it's
And
awesome.
then he talks about it in this YouTube one that you have there.
Okay.
It's an older one where he talks about the VWAP, but ours, he did that.
Okay. Yeah, I love it. So probably watching both of them, you'll have some crossover information, but I love hearing things more than once. So
Right.
So that's great. I'm glad we have both of them. So I saved the links over here. So all I did to save them, because you're right, you can't copy and paste. All you can do is open it in a browser and then copy the link in the browser and paste that somewhere where you can keep it or bookmark it. So you can bookmark it somewhere, right? Otherwise, I still have them. So if you're watching back on recording in this Stocks on the Rocks, send me an email, support@tradersarmy.com, support@tradersarmy.com. And just say, hey, can I get those links to that VWAP, those VWAP lessons? And I'll just shoot you an email. Because I know we have a lot of people that watch these back on recording, and I'll send them out that way.
Yeah, and hopefully whoever asked the question last time, whatever it was that he or she wanted to know is covered in this.
Yeah, I'd probably have to go back and look at that session and go back into Zoom and find the chat transcript, which is doable, and go find the person who asked that question, because that was the one from 3 weeks ago. It was just the last one.
Yeah.
So that would be easy to find.
And I thought that the question was just how do you know, or what do you use for VWAP 4, but I don't remember what the exact question was.
Yeah, I don't remember the exact question, but that's easy for me to go find out.
Yeah, but on the Zoom meeting, he shows us exactly how to set it up and everything in TradingView.
Love it. Sweet. Awesome, man. Thank you for digging on that. I appreciate you.
You're welcome.
Thank you. Thank you. All right. Everybody thank Jason. Thank you, Jason. All right.
Thank you, Jason.
Well, I guess that's it for tonight. Let's do this again next Thursday, shall we?
Yeah, this is great. Hi, Liz.
All right.
Been a while.
I'll see you guys in the trading rooms next week. I've got options trading rooms Monday and Thursday, and you have a whole bunch of futures and stock trading rooms next week as well. If you are not a member of Traders Army, what are you thinking? No, I'm teasing. So one little shameless plug here, tradersarmy.com.
Plug away.
What we do. Here's all the stuff that we do and things that we have. Memberships is where most people land because you get all the on-demand content, you get all the trading rooms, all the checklists, all the sheets, all the everything. And that will be the pro membership. Now, what I'll do is I'll throw it here so you can see it. Trader60. If you use that code Trader60 when you sign up for your month-to-month pro membership, check it out. That'll take 60% off your first month. And then the auto renewal will put you on the standard plan. There's also, I don't have any plans right this moment, but as we come into the holiday season, or near the end of the fourth quarter, we will be offering a lot of, deeper, discount opportunities, things like that. But this is a way to get checked out. This is our standard. Everybody gets 60% off their first month. So, yeah, have fun with that. That's all I got to say on that. This isn't a forum for that, but gotta say it. You know what I mean?
Don't ask, don't get.
Gotta say it. So, with that being said, enjoy your night, enjoy your weekend.
Thanks,
And I'll
Corey.
see those of you who are members in the trading rooms next week. And I'll see you guys undoubtedly in the Stocks on the Rocks next Thursday.
Thanks, Corey. Appreciate
Thanks,
it.
Corey. We'll talk
Thank
soon.
you, Corey.
Thank you. And I'm gonna try a new thing where I see us out with some music.
Ooh.
All right, bye, you guys.
All right. Bye, all.